Modern Money Mechanics was published by the Federal Reserve a few years ago as the Central Bank of the United States. The purpose of this article was to explain the Federal Reserve and the worldwide network of commercial banks it supports use institutionalized money production practices. The goal of this ebook is to explain the fundamentals of money generation in a fractional reserve banking system, and then to explain this fractional reserve process using different banking terms. It's a translation that runs like this. Because of the Federal Reserve, the United States government decides it needs some money, so it asks for $10 billion. And the Fed responds by saying that it will buy $10 billion in government bonds from you. So the government takes some paper, paints some official-looking designs on it, and calls them treasury bonds, then sends them over to the Fed. Hey, let's talk fractional reserve banking. As a result, the Fed's personnel dropped several outstanding pieces of paper. This time, referring to them as Federal Reserve notes were also assigned to a value of $10 billion to the group. The Fed then exchanges these notes for bonds, and the government then takes the $1 billion in Federal Reserve notes and deposits it into a bank account, officially adding $1 billion to the US money supply at this point. Here, we see the creation of $1 trillion in brand new currency. As with previous examples, this is a generalization. In reality, no paper is utilized in this transaction since only 3% of the US money supply is in the form of physical coins. The other 97% exist only in digital form. When the Fed buys government bonds with money it generated out of thin air, the government is really committing to pay back the Fed's money it purchased the bonds with. This is to say, the funds were produced as a result of an accumulation of debt. As we go farther into this activity, the paradox of how money or value may be generated from debt or liability will become clearer. Now that the transaction has been completed and a sum of $10 billion has been deposited into a business bank account, things start to get interesting. As with other deposits, a deposit of $10 billion becomes immediately part of the bank's reserve under the fractional reserve system. A bank must legally hold reserves equal to a predetermined proportion of its deposits, as stated in contemporary money mechanics. This is quantified by saying that the reserve requirement against the majority of transaction accounts is 10% under current laws. To put it another way, the bank keeps 10% more of a $10 billion deposit in reserve, while the other 90% of the deposit is considered an excess reserve and may be utilized as the foundation for future loans. It would be natural to believe that the $90 billion comes directly from a current $10 billion deposit, but this is not the case. Instead, the $90 billion is generated out of thin air on top of the existing $10 billion deposit, and this is how the money supply is enlarged. Although it is claimed in contemporary money mechanics, banks don't really give out loans from money they receive as deposits, since if they did, no new money would be generated because there is a need for such a $10 billion deposit in reserve. The $90 billion can be made out of nothing. In other words, because there is a $10 billion deposit in reserve, the $90 billion can be generated. Assuming someone enters into this bank and borrows the $900 billion, they would most likely put the money into their own bank account. The bank's reserves are then replenished by the deposit. There are now $8.1 billion available as freshly produced money for future loans, and, of course, that one may be lent out and redeposited to create an additional $7.2 billion. On average, the mathematical outcome of this deposit money generation loan cycle is $90 billion on top of the initial $1 million. Furthermore, 9 times as much money may be generated out of thin air for every deposit made in the financial system. Allies at the Bank of America are seeking a jar of money in the form of a personal loan from the bank. Now that we've seen how money is generated in this fractional reserve banking system, we may wonder what is truly providing this freshly minted money its worth. To this question, we can go no farther than the money that has already been created. The value of the current money supply is basically robbed by the introduction of new money. This is because demand for goods and services drives up the amount of money in the economy, which in turn causes price to rise, reducing the buying power of each dollar. It's known as inflation, and it's basically a hidden tax on the people. If you ask Eddie for advice, he'll probably tell you to raise interest rates, not debase the currency. He won't say, debase the currency, and he won't say, fraud the safe people. How can we expect to solve the problem of inflation, which is an increase in supply money, with more inflation? Of course not, because the fractional reserve monetary expansion system is inherently inflationary for the act of expanding money supply without there being a proportional reduction of the amount of money in circulation. To equal the worth of $1 in 1913, it took $21.60 in 2007. Since the Federal Reserve was established, the value of the dollar has fallen by 96%. As ludicrous as it may appear, the fact that our financial system is based on a system of constant and unstoppable inflation is not an exaggeration at all. Money is debt in our monetary system. That's money too. From 1950 to 2006, the US money supply may be seen in a graph below. Comparing the US national debt chart for the same time period, we see that the patterns are almost identical. Because the more money there is, the more debt there is, and the more debt there is, the more money there is. Debt-based money has already been discussed, and we've established that money is created out of debt through loans, which are based on the bank's reserve, which is derived from deposits. This fractional reserve system allows any deposit to create 9 times its original value, which debases the existing money supply and raises prices in society. Even though everything seems broken and backwards, there is one item missing from the picture, and it is the aspect of the structure that discloses the system's true deception: the use of curiosity. For example, whether a person or the government takes out a loan from the bank, they are virtually always required to repay it with interest. To put it another way, every dollar in existence must be repaid to the bank at some point, along with interest. Although commercial banks may boost their lending capacity by taking out loans from the central bank, this isn't ideal. The only thing that is generated in the money supply is the principal. So, where are we going to get the money to pay for all of the interest? Nothing. There is no such thing. As a result, inflation is a permanent feature of the economy, as new money is always required to make up for interest payments that are mathematically or literally built into the system. As a result, poorer regions of the society will always be left holding the bags when the music stops. An analogy would be a game of musical chairs, where once the music stops, someone is left holding the bag. And that's why I'm making this argument. It's impossible to escape the reality that the banks will seize your property if you fail your mortgage because of the fractional reserve method, and the fact that the money the bank loaned to you didn't even legally existed in the first place.